Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time, and all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is for the purpose of receiving the semi-annual testimony of the chair of the Board of Governors of the Federal Reserve System on monetary policy and the state of the economy. I now recognize myself for 3.5 minutes to give an opening statement. As we meet today, thanks to the fiscal policies of the Trump administration and this Congress, many Americans are seeing the strongest economy of their lifetimes. Most importantly, 3% average economic growth is back. 90% of Americans are seeing bigger paychecks, and in the last quarter, real disposable income increased a very strong 3.4%, and unemployment remains near a 50-year low. But the economy may be challenged in significant ways if either we find ourselves in a protracted global trade war or the unconventional monetary policy tools of the Fed are not carefully and skillfully wound down and transitioned to normalcy. In February, during our last Humphrey Hawkins hearing, I questioned whether the Fed would ever return to a monetary policy balance sheet after a decade of accumulating and maintaining, in contrast, a macro-prudential balance sheet, and my concern remains because less than a year into the Fed's balance sheet wind down, some FOMC members are already calling to slow down or end the process. We were told by the Fed that letting the roll-off schedule run for 3 or 4 years would be less exciting than watching paint dry. But as we meet today, we face the prospect that maybe the paint stays wet. In other words, we seem to be faced with an increasing prospect of a balance sheet that may never return to a more conventional size or composition. I believe this is problematic. An unconventional balance sheet may well threaten, ultimately, the integrity and independence of the Fed's conduct of monetary policy by enabling competing activities that lie outside its mandate for stable prices and full employment. This matter must be reviewed carefully. Additionally, I have governance concerns. I would note today that only 3 individuals, as a practical matter, are actually empowered to set U.S. monetary policy. This is a matter of concern. We know that interest rates on reserve deposits have now supplanted open market operations of the FOMC and playing the lead role in conducting monetary policy. Given that the Board of Governors can administer interest rates on reserve deposits without any input from the FOMC or any district bank president. This means 3 individuals, or to be more precise, 2 given a majority vote, set monetary policy in the U.S. I certainly don't believe this is currently being abused, but I do believe, as a matter of public policy, the full FOMC should vote on where to set interest rates on reserve deposits. And furthermore, I would call upon the Senate to expeditiously confirm the Federal Reserve Board governors that the President has long since nominated. Finally, many members, including myself, share a concern about the apparent inconsistency of a 2% inflation target with the goal of price stability. 2% inflation target means that every dollar a couple sets aside at a child's birth for her college education will have lost approximately 30% of its purchasing power by the time the first tuition bill arrives. I understand that other central banks do this. I understand this may be good policy, but if so, Congress should decide this, because Section 2A of the Federal Reserve Act mandates, quote, stable prices. And last I looked up the word stable in the dictionary, it means, quote, unquote, fixed, quote, unquote, not changing, or, quote, unquote, permanent. And yet we see even some advocating a policy rate target that allows for even greater swings than the current 2% inflation target. Chairman Powell, we welcome you, and we look forward to hearing more about these issues, and we look forward to a prudent path to normalization where interest rates are once again market-based and credit is allocated to its most efficient use. I now recognize the ranking member of the committee, the gentlelady from California, for 3 minutes for an opening statement.
Thank you, Mr. Chairman, and welcome, Chairman Powell. Mr. Chairman, I'm very concerned about the impact of the reckless economic policies of Donald Trump on hardworking Americans, vulnerable families, and our nation's economy. This president has started a trade war that is already harming American consumers and companies. For example, Whirlpool, based in Michigan, has seen its share price drop over 15% as a result of Trump's tariffs on steel and aluminum. Washing machines and dryer prices have increased 20%. According to the Wall Street Journal, the mayor of Clyde, Ohio, where Whirlpool has a plant, commented on the tariffs saying, I quote, "People's anxiety level is higher because nobody knows what's going on," quote unquote. The tax scam that the congressional Republicans and President Trump pushed through explodes the deficit and raises taxes on 86 million American families to help out big corporations and very wealthy individuals. But most of these corporations are not using the windfall to pay better wages to their employees. Instead, they're buying back their own stock to boost share prices and enrich their CEOs. And in the end, this massive, misguided giveaway will be paid for by future generations of taxpayers. In addition, the Trump administration's latest budget proposal makes deep cuts to important health care, nutritional assistance, housing and community development programs, and would be detrimental to families, veterans, seniors, and persons with disabilities. In all, the Trump administration's policies are deeply harmful and threaten the hard-earned economic gains put in motion during the Obama administration. As a result of Democratic policies and the policies of the Federal Reserve, we are now experiencing the longest stretch of private sector job growth on record. But with these harmful economic policies, Trump is putting all of that progress at risk. So I'm very interested in Chairman Powell's views on these matters, especially the long-term effect of Trump's damaging economic policies and what tools, if any, the Federal Reserve has to prevent a possible recession that could be triggered by the policies of this administration. With that, I yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from Kentucky, Mr. Barr, the chairman of the Monetary Policy and Trade Subcommittee, for 1.5 minutes.
Thank you, Mr. Chairman. And Chairman Powell, thank you for testifying today. As Chairman Hensarling has already stated, the economy is strong and the data support this statement. Americans have more money in their paychecks thanks to tax reform. Job creation is strong. Unemployment is near a 50-year low. And many Americans who left the workforce during the financial crisis are re-entering it. While overall, the economic outlook of America is bright, there are a few items that we need to carefully watch. One is uncertainty surrounding U.S. trade policy, which impacts key Kentucky industries such as bourbon, agriculture, and auto manufacturing. Another is the legacy of the Fed's unconventional monetary policies and bloated asset sheet that continues to distort credit allocation. A third is a flattening yield curve that some economists warn could signal a downturn. And a final risk is out-of-date regulation, such as the GSIB surcharge calculation that puts American banks at a disadvantage relative to their international competitors. Chairman Powell, thank you for your service at the Federal Reserve, and I look forward to hearing from you today about these and other important topics. I yield back.
Gentleman yields back. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, the ranking member of the Monetary Policy and Trade Subcommittee, for 1 minute.
Thank you so much, Mr. Chairman. And Mr. Chairman, it's lovely to see you again. I'm going to paraphrase and channel Ben Franklin here. Dodd-Frank gave America a stable economic system if we can keep it. I fear your greatest challenges in the future will be directly related to the actions of Republican policymakers and our president. Ruinous trickle-down tax cuts, adopting their policies that drive debt and income inequality, and of course the Wells Fargo model to saddle regular Americans with forced-place payday loans to pay it all back. Destabilizing financial deregulation and unqualified nominees like Kathy Kraninger to head the Consumer Financial Protection Bureau. Capricious trade wars, Harley in my district, farmers in my state bracing for ruin, fiscal mismanagement, low-grade scams, and incompetence all seems to be hallmarks of Mr. Trump. But you know, as we discussed Esther 4:14, you have been called for such a time as this. God bless you.
Gentlelady yields back. Chair now recognizes the gentleman from Michigan, Mr. Kildee, the vice-ranking member, for 1 minute.
Thank you, Mr. Chairman, for yielding, and Chairman Powell, thank you for being here. I lead an initiative in Congress entitled The Future of America's Cities and Towns. Its purpose is to fuel a national conversation around the economic health of our country's older industrial cities and towns, places like my hometown of Flint that have not fully recovered from the Great Recession. Even with the job growth and economic recovery we've seen, it's uneven. In economic terms, there is no average American anymore. A whole cohort of communities across the country continue to experience the kind of stress that threatens their sustainability as communities and the fiscal solvency of their municipalities. I believe we have to have a much more serious and thoughtful conversation about how we support these places and the millions of people who live there. Many of the regional banks, such as the Boston, Cleveland, and Chicago banks, have taken an interest in working to improve the fiscal health of these places within their jurisdiction. And so I would be interested in hearing your thoughts on how the Fed can help these places. Monetary policy is by nature a broad tool for economic growth, but we must have a particular focus on creating more economic opportunity for those families and those communities that continue to struggle. Thank you, Mr. Chairman, for your indulgence.
If that's how you interpret indulgence.
You didn't cut me off.
Today, we welcome back to the committee for his second appearance, Governor Powell, Chairman of the Board of the Governors of the Federal Reserve System. Governor Powell has previously testified for this committee, so I believe he needs no further introduction. Without objection, the witness's written statement will be made part of the record. Chairman Powell, you are now recognized for your testimony. Welcome.
Thank you very much, and good morning, Chairman Henseling, Ranking Member Waters, and other members of the committee here today. I'm happy to present the Federal Reserve's Semiannual Monetary Policy Report to Congress. And let me start by saying that my colleagues and I strongly support the goals that Congress has set for us for monetary policy, maximum employment and price stability. We also support clear and open communication about the policies we undertake to achieve these goals. We owe you and the general public clear explanations of what we are doing and why we're doing it. Monetary policy affects everyone and should be a mystery to no one. For the past 3 years, we have been gradually returning interest rates and the Fed's securities holdings to more normal levels as the economy strengthens. And we believe this is the best way we can help set conditions in which Americans who want a job can find one and in which inflation remains low and stable. I will review the current economic situation and outlook and then turn to monetary policy. Since I last testified here in February, the job market has continued to strengthen and inflation has moved up. In the most recent data, inflation was a little above 2%, the level that the Federal Open Market Committee thinks will best achieve our price stability and employment objectives over the longer run. The latest figure was boosted by a significant increase in gasoline and other energy prices. An average of 215,000 net new jobs were created each month this year in the first half of the year. That number is somewhat higher than the monthly average for 2017. It's also a good deal higher than the average number of people who enter the workforce each month on net. The unemployment rate edged down 0.1% over the first half of the year to 4.0% in June, which is near the lowest level of the past 2 decades. In addition, the share of the population that either has a job or has looked for one in the past month, what we call the labor force participation rate, has not changed much since late 2013, and this development is another sign of labor market strength. Part of what has kept that participation rate stable is that more working-age people have started looking for a job, which has helped make up for the large number of baby boomers who are retiring and leaving the workforce. Another piece of good news is that the robust conditions in the labor market are being felt by many different groups. For example, the unemployment rates for African Americans and Hispanics have fallen sharply over the past few years and are now near their lowest levels since the Bureau of Labor Statistics began reporting data for these groups in 1972. Groups with higher unemployment rates have tended to benefit the most as the job market has strengthened. But jobless rates for these groups are still higher than those for whites, and while 3/4 of whites responded in a recent Federal Reserve survey that they were doing at least okay financially in 2017, only 2/3 of African Americans and Hispanics responded that way. Incoming data show that, alongside the strong job market, the U.S. economy has grown at a solid pace so far this year. The value of goods and services produced in the economy, or GDP, rose at a moderate annual rate of 2% in the first quarter after adjusting for inflation. However, the latest data suggests that economic growth in the second quarter was considerably stronger than in the first. And this solid pace of growth so far this year is based on several factors. Robust job gains, rising after-tax incomes, and optimism among households have lifted consumer spending in recent months. Investment by businesses has continued to grow at a healthy rate. Good economic performance in other countries has supported U.S. exports and manufacturing. And while housing construction has not increased this year, it is up noticeably from where it stood a few years ago. I'll turn now to inflation. After several years in which inflation ran below our 2% objective, the recent data are encouraging. The price index for personal consumption expenditures, or PCE inflation as we call it, which is an overall measure of prices paid by consumers, increased 2.3% over the 12 months ending in May, and that number is up from 1.5% a year ago. Overall inflation increased partly because of higher oil prices, which caused a sharp rise in gasoline and other energy prices paid by consumers. Because energy prices move up and down a great deal, we also look at core inflation. Core inflation excludes energy and food prices and is generally a better indicator of future overall inflation. Core inflation was 2.0% for the 12 months ending in May, compared with 1.5% a year ago. We will continue to keep a close eye on inflation with the goal of keeping it near 2%. Looking ahead, my colleagues on the FOMC and I expect that with appropriate monetary policy, the job market will remain strong and inflation will stay near 2% over the next several years. This judgment reflects several factors. First, interest rates and financial conditions more broadly remain favorable to growth. Second, our financial system is much stronger than before the crisis and is in a good position to meet the credit needs of households and businesses. Third, federal tax and spending policies will likely continue to support the expansion. And fourth, the outlook for economic growth abroad remains solid, despite greater uncertainties in several parts of the world. Now, what I have just described is what we see as the most likely path for the economy. Of course, economic outcomes that we actually experience often turn out to be a good deal stronger or weaker than those in our best forecast. For example, it is difficult to predict the ultimate outcome of current discussions over trade policy, as well as the size and timing of economic effects of the recent changes in fiscal policy. Overall, we see the risk of the economy unexpectedly weakening as roughly balanced with the possibility of the economy growing faster than we currently anticipate. Over the first half of 2018, the FOMC has continued to gradually reduce monetary policy accommodation. In other words, we've continued to dial back the extra boost that was needed to help the economy recover from the financial crisis and the recession. Specifically, we raised the target range for the federal funds rate by 1/4 percentage point at both our March and June meetings, bringing the target today to its current range of 1.75% to 2%. In addition, last October we started gradually reducing our holdings of Treasury and mortgage-backed securities, and that process has been running quite smoothly. Our policies reflect the strong performance of the economy and are intended to help make sure that that continues. The payment of interest on balances held by banks in their accounts at the Federal Reserve has played a key role in carrying out these policies, as the current monetary policy report explains in some detail. Payment of interest on these balances is our principal tool for keeping the federal funds rate in the FOMC's target rate range. This tool has made it possible for us to gradually return interest rates to a more normal level without disrupting financial markets and the economy. As I mentioned, after many years of running below target, our longer-run objective of 2% inflation has recently moved close to that level, and our challenge will be to keep it there. Many factors affect inflation. Some of them are temporary and others longer-lasting. Inflation will at times be above 2%, at other times below. And we say that the 2% objective is symmetric because the FOMC would be concerned if inflation were running persistently above or below that 2% objective. The unemployment rate is low and expected to fall further. Americans who want jobs have a good chance of finding them. Moreover, wages are growing a little faster than they did a few years ago. That said, they're still not rising as fast as in the years before the crisis. One explanation could be that productivity growth has been low in recent years. On a brighter note, though, moderate wage growth also tells us that the job market is not causing high inflation. With a strong job market, inflation close to our objective, and the risks to the outlook roughly balanced, the FOMC believes that for now, the best way forward is to keep gradually raising the federal funds rate. We are aware that, on the one hand, raising interest rates too slowly may lead to high inflation or financial market excesses. On the other hand, if we raise rates too rapidly, the economy could weaken and inflation could persistently run below our objective. The committee will continue to weigh a wide range of relevant information when deciding what monetary policy will be appropriate. As always, our actions will depend on the economic outlook, which may change as we receive new data. For guideposts on appropriate policy, the FOMC routinely looks at monetary policy rules that recommend a level for the federal funds rate based on the current rates of inflation and employment. The July Monetary Policy Report gives an update on monetary policy rules and their role in our policy discussions. I continue to find these rules helpful, although using them requires careful judgment. Thank you very much, and I will look forward to our conversations.
Thank you, Chairman Powell. The chair now yields to himself 5 minutes for questions. I don't believe, Chairman Powell, there was a discussion about this on the Senate side yesterday. I didn't hear much about it in your testimony. But I would still seek greater specificity on the current goals for the wind down of the balance sheet. It is my current understanding, again, that it is the goal with respect to the pace that this wind down will take about 3 to 4 years, that ultimately the size of the balance sheet as of today, the target is $2 to $2.5 trillion, and with respect to composition, primarily treasuries, but some MBS. Is my understanding correct? Is that the current goal of the Fed? And I'm sorry, if you could pull the microphone a little closer to you, Chairman.
How's that? Okay.
Much better, thank you.
So the plan is to return the balance sheet over time to a mainly Treasuries balance sheet. I've provided estimates, others have provided estimates of how long that will take. They're fairly uncertain, but my estimate has been 3 or 4 years. What will guide the time at which we will ultimately stop shrinking the balance sheet will really be a function, and the ultimate size of the balance sheet will really be a function of the public's demand for our liabilities. During quantitative easing, that was really about assets. In the long run, what matters is the public's demand for currency, which has grown very strongly for the last few years, and also the public's demand for reserves. And in an era where we require the banks to have lots of high-quality liquid assets, reserves are the ultimate high-quality liquid assets. So I think we're going to be finding out how big that demand is for those two liabilities and also some others. And, I think there are estimates. We don't have a target range, for example. It's not the...
Okay, so you really don't know. Obviously,
right.
we all acknowledge there will be a greater demand for reserves, but I still would anticipate that in the $2 to $2.5 trillion, that might actually exceed demand. So I guess, Chairman Powell, my next question is it a goal of the Fed? So I understand you want to keep IOER, that you, particularly today, this is how monetary policy is determined. But do you see a day, is it the goal of the Federal Reserve to, again, have open market operations, the FOMC, primarily drive monetary policy? So I guess this is really the debate between kind of the floor and the corridor. Currently, we are using the floor, but is that the ultimate goal? Is this a permanent tool, or will we see a future where IOER sets the floor, the FOMC sets the higher end, and let the market determine the interest rate in between that floor and ceiling? What is the goal of the Fed?
The committee has not made a decision on whether in the longer run we'll go back to a corridor system or stay in what we have now, which is a floor system. And
when might the Fed contemplate this?
We'll be returning to that question, I'd say, fairly soon. It's something we've talked about periodically at various FOMC meetings, and my thinking is that we will return to it return to that discussion in a serious way in the relatively near future.
Well, one thing I would have you consider, Chairman Powell, as the Board of Governors takes a look at this, is ultimately the potential risk to the Fed's independence of having such an unconventional sized balance sheet. As you know, I would say regrettably, Congress raided a relatively small fund of the Federal Reserve to fund a transportation bill. I tried to fight that. I wasn't successful. It's been raided twice, so I've joined in with my colleagues. We also know now that the Fed funds the Bureau of Consumer Financial Protection. Both of these have nothing to do with monetary policy. I could foresee a day with a large balance sheet out there and with the potential of either municipalities of states on the brink of insolvency, having Congress decide the Fed needs to buy their bonds and prop them up. I can also see one day an infrastructure bill coming down the pike. No good way to pay for it. There's a big pot of money that the Fed has. Maybe the Fed should be directed to buy these bonds. And I think we're seeing some of this, frankly, across the pond. When I look at the Swiss Central Bank or the ECB. So I'm just curious, as you think about the size of your balance sheet, do you ever consider its impact on your independence?
We do think about those things, and we've said that the balance sheet will return to a size that's no larger than it needs to be for us to affect monetary policy in our chosen framework.
Well, I just assure you, Mr. Chairman, if there's a big pot of money out there, this Congress might find a way to get its hands on it, so you might consider that as you consider the size of your balance sheet. Time of the chair has long since expired. The chair now recognizes the ranking member.
Thank you, Mr. Chairman. Chair Powell, while I've heard you state repeatedly that it is too soon to tell whether the economic efforts of the recent implementation of tariffs will be either positive or negative, there are already serious indications that we are headed for trouble. In the most recent June FOMAC meeting minutes, several participants noted that their district business contacts had expressed concern about the adverse effects of tariffs and other proposed trade restrictions on future investment activity, and that they were not planning any new investments to increase capacity. Mid-Continental Nail, America's largest nail manufacturer, based in Missouri, has already laid off 60 workers and expects to go out of business by Labor Day. Harley-Davidson, based in Wisconsin, is moving jobs overseas to Europe to avoid tariffs on its exports. Whirlpool, based in Michigan, has seen its share price drop over 15% as a result of Trump's tariffs on steel and aluminum. Washing machine and dryer prices have increased 20% in the past 3 months as a result, the steepest rise in the past 12 years, according to the Department of Labor. These tariffs are affecting the price of everything from bicycles to washers to automobiles. In addition to these immediate effects, to your point, there may be delayed negative effect on the economy as well. While the U.S. is taking a protectionist stance toward trade policy, the rest of the world is moving forward on trade without us. What long-term economic effects can we expect to see if these tariffs continue to escalate to the point of a trade war? Do you expect the economic effects of a trade war to be felt more acutely in certain regions of the U.S.? And furthermore, if the Fed is it well-suited to respond to a recession caused by a trade war? If not, what can be done?
I should start by quickly reminding all of us, including me, that we stay in our lane at the Fed, and when we talk about things like fiscal policy and trade policy that are not assigned to us, we try to stay at a high level, at principal level. But answering your question, if this process leads to a world of higher tariffs on a wide range of goods and services that are traded, and those are sustained for a longer period of time, in other words, if it results in a more protectionist world, that'll be bad for our economy. And it'll be bad for other economies, too. It'll be bad for the world economy. That is not what the administration says they're trying to achieve. And again, it isn't up to us to criticize their policies in this activity. But, you know, the evidence is clear that countries that remain open to trade have higher productivity, they have higher incomes. Not every group is affected positively by trade. There are groups that are hurt by trade, and I think all countries have learned that they need to do a better job of addressing the needs of those populations, but not through trade barriers and tariffs of that kind of thing.
While certainly the feds do not have direct responsibility for trade and for tariffs, are you consulted at all when the tariff decisions were made?
No, we play no role in the administration's discussions on these. We, like I imagine just about everyone here, we hear from our extensive network of business contacts a rising chorus of concern. As you pointed out, lots and lots of individual companies have been harmed by this. We don't see it in the aggregate numbers yet because it's a $20 trillion economy and these things take time to show up. But we hear many, many stories of companies that are concerned and now beginning to make investment decisions or not make them because of this.
Have you had any action at all in relationship to the Chamber of Commerce? Have they talked with you? Have they sought your opinion? Have you talked with them? What do you know about the Chamber of Commerce position on tariffs?
Well, I saw that they took a very strong public position against tariffs. We have, try to have good relations and strong relations with the Chamber. I haven't personally discussed their position on trade, but I know what it is.
Do you know what specifically they were concerned about as it relates to tariffs, any particular part of the country, agriculture, et cetera?
I shouldn't speak for them, but I think it's really a general thing. I mean, the bottom line is a more protectionist economy is economy that's less competitive, it's less productive. We know that. This is the torch we've been carrying around the world for 75 years. So it's not a good thing if that's where this goes. We don't know ultimately yet where this process will lead. The administration says they want lower tariffs, and that, I think, would be good for the economy if we achieve that.
Well, thank you very much, and I yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from Kentucky, Mr. Barr, chair of our Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman. And Chairman Powell, welcome back to the committee. As you know, some economists argue that a flattening of the yield curve is an indication that an economy is headed for a recession. Obviously, with the strong data that we're seeing, we don't see any kind of indication of a recession in the near term. But I asked you this question 6 months ago in your last report, and I asked you, given the flattening of the yield curve and the risk potentially that short-term rates might exceed long-term rates, whether there would be any plans within the normalization strategy to accelerate the roll-off of longer-term assets more quickly to counteract the flattening of the yield curve. I believe you indicated that there were no such plans 6 months ago. I just wanted to ask you, given the fact that that yield curve has flattened even further in the interim since we last met, is there any discussion within the FOMC to alter or accelerate the balance sheet reduction program in contemplation of this flattening yield curve?
Thank you. No, there's not. We very carefully developed and socialized to the public the balance sheet reduction, balance sheet normalization plan. It's working smoothly. We're not thinking really about changing it, except in the conditions that we've identified, which would be, a meaningful downturn.
Yeah. If that's the case, what is the Fed's plans with respect to that flattening yield curve, and what risks does that pose to the economy?
Maybe let me tell you how I think about the yield curve. So I think we know why the short end of the yield curve is moving up. It's because essentially out to 2 years or so, really the market is pricing in its expectations of what the Fed will do, plus or minus maybe a little bit of a term premium when you get out to 2 years. So we know why the short end is moving up. The real question is, what's the story with long rates? So the long rate, like take the 10-year Treasury, you have to decompose that and ask what's in it. And I think the whole point of the yield curve conversation is that you can decompose that, and in that whatever the long-term rate is, 2.85%, I guess this morning, the 10-year. What's in there is a term premium, but there's also sort of the market's estimate of the long-run neutral rate. And so it's telling you something, and we're listening, but it involves many other things. You've got to kind of do a decomposition to pull that out, and then that tells you what the stance of monetary policy is. So, whether policy is accommodative or whether it's restrictive, and that is the important question, not the shape of the yield curve.
Chairman, would you agree that the oversized balance sheet is putting downward pressure on those long-term interest rates, continues to put downward pressure?
Yes, but to a diminishing degree.
Let me switch gears to IOER. For decades now, the Board of Governors has administered interest rates on reserves not for the intended purposes of fairly compensating commercial banks for required deposits at Federal Reserve banks, but rather as a monetary policy rate. Given the fact that IOER is now your principal tool for interest rate setting, would it not be better if IOER was set by the FOMC, a much more diverse body that includes not only the governors, but also the 5 voting district bank presidents, as opposed to just the Board of Governors?
I guess I think of it this way. The FOMC sets the target range for the federal funds rate. IOER is just a tool to make sure that the federal funds rate trades in the range that has been set by the FOMC. So it's really just a tool to follow through on the much more important decision, which is made by the FOMC.
Well, thank you. And as you know, and as we've discussed, this committee and the Congress is considering a proposal to transfer that responsibility of IOER to the FOMC, the larger, more diverse group, and we continue to engage you on that. Let me finally conclude with a question about trade. I agree with your assessment that free trade and low tariffs result in better economic performance as opposed to a trade war or high tariffs. How important is it for the administration to quickly resolve its trade and tariff negotiations, and what are the risks of a protracted period of increasing tariffs?
Again, wanting not to be an advisor or in any way a participant in these discussions, which are really up to the administration. Uncertainty, is one of those things where businesses, there's a lot of momentum in the economy earlier this year. I wouldn't want to see uncertainty lead people to start putting off decisions and that kind of thing. And that would be the risk of a long, protracted discussion.
Thank you for your answers. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, ranking member of the Monetary Policy and Trade Subcommittee.
Thank you so much, Mr. Chairman. And again, welcome back, Mr. Chairman. You talk a lot about productivity, and indeed, economists keep talking about an aging population, the boomers, then that's impacting productivity, and how lagging productivity is an ongoing drag on economic growth. I am wondering if you think that having a comprehensive immigration policy would help increase productivity.
Immigration is another one of those policies that's high up on the list of things that are not assigned to us, but I can still, so I'm going to try to stay in our lane. But I do think, to the extent these issues connect to the health of the economy in the long run, then we have an obligation to speak to that. So If you think about potential growth in the United States, you can really boil it down to how fast is the labor force growing, and how much is output per hour growing. That's it. That's all you have, right?
And our CRS does anticipate that over the next decade or so, it could increase our economy by $1 trillion to get these people out of the shadows. You talk in your remarks about the lower unemployment rates for African Americans and Hispanics. That's something we're all celebrating. But I swear to you, I know a lot of African Americans that are related to them. I don't know many that don't have 2 jobs in order to make it. I know some who have bachelor's degrees, and yet they're forced to live with roommates because they can't sustain themselves. So what we have found is that while there might be lower unemployment, wages have actually decreased. Despite the tax cuts, which claimed that there were going to be $4,000 for everybody, or we know we got these one-time only bonuses, wages have decreased, and income inequality has increased. And I'm wondering what your projection is for flat or lowered wages despite increased unemployment.
We look at a wide range of wage and compensation indicators, and pretty consistently across the board, if you look back at where they were 5 years ago and look back where they are now, they've all moved up. They used to be right around 2% increase per year. Now they're around 3%. We think this is a good thing.
African Americans, their wages are increasing?
Yes, I mean, I think it's pretty broad at this point in different.
And I would surely like to see these data because other economists have said that it's actually decreased. All right, thank you. I am wondering, I know you aren't going to ask any questions about the tax cuts, so I'll let you off. I am wondering, though, about the big tax cut. I've got to ask. The big tax cut that we just provided, and it's increased income inequality. I am just wondering what your thoughts are and projections about how sustainable that is when 80% of these tax cuts have gone for shareholder-type buybacks versus increase in wages or capital improvements. I'm wondering what you think for the going forward, what impact that'll have on economic growth.
I think that the U.S. fiscal policy has been on an unsustainable path for some time. It continues to be unsustainable.
Higher debt?
Yeah, I mean, the debt's going up, and I think it's growing faster than the economy. We need to get the economy growing faster than the debt. It comes down to that, and we're not doing that. It's something we should be working on now. We should all be working on that together.
I mean, do you think that shareholder buybacks is a healthy indicator of healthy prospect for growth?
I think when a company decides to buy back stock, they're saying that we have more cash than we can put to work for our shareholders. That's kind of the capital markets working. That money doesn't go away. Of course, it goes into people who then can spend it or other.
And I mean, this is more money for them to use to chase yield. I mean, don't you think that the chasing of yield creates bubbles, and that's one of the big problems that we had in 2008? Just money chasing yield?
I think we certainly can find ourselves in a situation where we're seeing financial bubbles and that kind of thing. We watch that very closely. Don't see that now, but it's a key risk that we monitor very carefully.
And I thank you so much, sir.
Thank you.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, chairman of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and welcome, Chairman Powell. Yesterday we had a hearing with our Financial Institutions Subcommittee, and I asked the question of Acting Comptroller of the Currency, Keith Norica, about the implementation of Senate Bill 2155, and specifically whether or not the statutory language around the $250 billion threshold for SIFI designation was clear. Mr. Norica said that the language and congressional intent was pretty straightforward. And so my question to you is, would you agree with your former colleague that the language is pretty clear, no ambiguity there, that you know exactly what should be done with those banks under 250 with regards to SIFI activity and testing?
I think that it's very clear, and I think the language gives us the authority that we need.
Okay, so now we know what we should be doing. How long would you anticipate it's going to take to implement the statute with regards to 2155?
So with regards to that particular provision, we're thinking already about exactly how we will, the framework we're going to publish for comment and receive public comment on that will allow us to identify systemic risk or risks to safety and soundness among banks below 250. The other aspects of 2155 were already out the door. We published a document on Friday of July 4th week, which talked about how many things that we're doing. We have a big job to implement 2155, and we're going at it very hard.
Thank you very much. And it's nice to know that, or it should be noted anyway, that those banks under 250 are not significantly important financial institutions standpoint of endangering the economy. That's what a SIFI is supposed to be, a bank that would endanger, while they're nice-sized banks, they're not something that's going to endanger the economy, and therefore they fall under different regulatory regimes. So we thank you for that. With regards to another issue I brought up yesterday, former Governor Dan Tarullo said in his farewell address that stress testing programs should be moved into the normal examination cycle. And I agree with that proposition and said, while I don't underestimate the importance of stress tests, those tests should be run by regulators. Banks are doing this right now on a regular basis with regulatory oversight. Would you agree with Governor Tarullo that we need to sort of assimilate those exams, the stress testing things, into the regular examination cycle, or do you want to retain those as a separate type of testing that the banks are going to be putting out information for and modeling?
I believe he was talking about the qualitative aspect of the test.
Right.
Right. So we are looking to return the qualitative part of the test over time to the regular examination cycle, and we're looking for the right way and time to do that.
Well, it seemed to me, just to throw ideas out, that it would seem to me that if we would, if the Fed would have several different models, and then they would go into the bank, take the information from it, throw into those models to see if there is a area within the bank's business model that is of concern, that could be pointed out by the various models and update those models on an annual basis or whatever it would take. But it seems to me like now that the stress testing is a game of gotcha. The models are not disclosed until the very last instance, and then are the models going to actually be useful? So I think I would hope that you would think along those lines, that you could assimilate it into part of the examination process, take the information, and put it into several different models to see if there is a weakness somewhere in the bank's business model. Does that make sense?
Yes. So as you know, we're working hard to make the quantitative side of the test and the qualitative side more transparent to the public generally and to the firms, and we think that that's a key innovation. We've got a proposal out on that.
And one of the things, also with regards to international banks, I've had some visits from our friends across the pond recently, and so while I'm a staunch advocate for capital, I'm also concerned about this notion that arbitrarily parking capital around the globe creates a safer financial system. The Fed started this trend with FBO rule, something I pointed out to Chair Yellen during her tenure. Now Europe is following suit with the immediate parent undertaking rule, which will hit the U.S. and ultimately UK banks. It seems as though we're finding ourselves in a global back and forth here with regards to capital. Would you agree with that, or what are your comments?
I think we feel like our intermediate holding company regulation is working. It's settled down now, and it's working. We've been consulted as Europe has looked at something similar to that, and I think the last time I checked, we felt that our concerns were being reasonably well addressed. I'll look back, though, to make sure that's right.
And one of the questions I got yesterday from a group of politicians from Europe was with regards to equivalency. And I'm not a big fan of that from the standpoint of the equivalency of rules and regulations. Somebody wins and somebody loses. And I'm fearful that we're going to lose in that situation. So just a comment. Thank you very much for being here. I'll yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Cleaver, ranking member of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman, and thank you for being here, Mr. Chairman. Last week we were here having a conversation with Secretary Mnuchin, and when I raised issues. They related to the fact that I represent a rural part of the state of the state of Missouri. Excuse me. And I had a town hall meeting in Higginsville, Missouri, 2 weeks ago, and brought in the Canadian Consul General to talk with the farmers in my district. Standing room crowd. Nobody in there supported what was going on. Many of the farmers, or some of the farmers, are questioning either, whether they should allow the beans to just stay in the fields this year, because as you probably know, the price is continuing to fall since the tariffs were implemented. First of all, I'm concerned about whether or not the harm could spread and do damage to the economy. I know you asked a similar question earlier, but it stands to reason that if the soybean crop is damaged, as it apparently is, there has to be some kind of a rippling effect. And I'm wondering, right now we're just talking mainly about, some farm products from my state. I think China buys $60 billion a year in soybeans, just in soybeans, $60 billion, and from us, from the United States. So, I mean, if you just deal with the $60 billion, is there a cause to be concerned about the damage that other parts of the economy could experience?
The answer would be yes. I mean, you're just beginning to see that the retaliatory tariffs come into place. They're only just beginning, and so we hear a few reports here and there about this company and that company. The agricultural patch is clearly very seriously affected, but it's just beginning. So I think, you want to be careful to walk on this path because it may not be so easy to get off it.
And I have a weird. I have a large rural part of my district, and then I have the largest city in the state, Kansas City, in my district. And so I've talked about my farm problem. When I was mayor of Kansas City, I was successful in bringing Harley-Davidson to Kansas City. They built a new plant, went up to 1,000 employees. We made an investment as a city. Of course, we're now facing the possibility of an empty building. But the steel tariffs are going to also have a rippling effect. The Smoot-Hawley Act is credited with making the depression even worse. But I'm just wondering if you're not going to answer this question. I understand it. So it's almost a statement. I have to say it. I think when decisions like this are made, they probably should be made with the legislative branch of the government, because the issues are too significant for one human being on the planet. I don't care if it's a Democrat or a Republican or, the member of the Oakland Raiders. We're talking about the world economy being impacted, and only one person has something to say. And frankly, Congress hasn't spoken on issues like this since 1930. I mean, we've just been frozen out of the process on an issue that can impact the entire world. Thank you for listening to me. And I'd also just like to yield back, Mr. Chairman. I'd also like to express appreciation that you speak English. When I was first elected to this committee, we didn't, a lot of people from the Fed didn't speak English.
Thank you. Thanks.
Thank you.
The chair takes note that the chairman of the Fed speaks English. Chair now recognizes the gentleman from Michigan, Mr. Huizinga, chairman of our Capital Markets Subcommittee.
Thank you, Mr. Chairman. Chair Powell, good to see you again. And I think my friend from Missouri is very pleased to hear English versus economies or economistism or whatever you want to tag it with, but this clearly is some kind of complicated stuff. I've got a number of issues I want to hit on very briefly, and one of them is just kind of a simple thing, something that we have talked about with the FEC, the Form Acts bill that I had proposed previously. We had a provision that we put in there that each Federal Reserve Board governor should be able to hire up to 2 senior staff members, and just wondering if you could maybe briefly comment on that, or whether you've looked at that.
I think it's a good idea. Don't need legislation on it. That's kind of now the rule.
All right. Well, good. We're making progress already. As chair of the Monetary Policy and Trade Subcommittee, I had worked on monetary policy and how the effects of that. Now, as chair of the Capital Markets Subcommittee, we still see a lot of that tie-in and sort of the world economy and the health of what's going on. I've got some real concerns about the Volcker Rule situation. Last month, the Fed, along with the other 4 federal agencies, something that Mr. Quarles had called the 5-headed Hydra at one point, had put some proposed rule changes in there. And my understanding is that the goal of the new rule is to simplify the regime and make it easier on the regulators as well as the regulated institutions to identify proprietary trading while allowing banks and to continue providing important market-making activities. How do these reforms address the Volcker Rule so that compliance can be streamlined, rules clarified, and markets actually made more efficient?
I think for the smaller institutions, we'll be streamlining quite a lot. Let me say this rule is out for comment, and we're very, very open to better ideas how to do this better. But we want to stay faithful to Congress's intent, which is these institutions, particularly the largest ones, should not have big proprietary trading businesses, shouldn't be doing proprietary trading as a business line. So
I look forward to continuing exploring how the Fed and FOMC will be properly tailoring the Volcker Rule. However, I have been hearing some complaints for some companies that the proposed rule as introduced has a new concept of using accounting rules to identify prop trading, which were not included in the original Volcker Rule. And I've been told that this could actually result in more activities getting caught up in the Volcker regime than there are pulled in today. I'm just, can you please tell me how that result to simplify the rule appears to make it actually a little more cumbersome and complex? My understanding is new metrics regime could result in a roughly 50% increase in metrics reporting by the banks subject to the rule.
That's not the intent at all, and I assume we're going to see those comments through the comment process, and believe me, we'll give them careful consideration.
Okay, and we're kind of wide-ranging and far afield here on a number of issues. My next issue, page 39 in your report, you had your chart about the rules. You mentioned this on page 5 of your testimony. You gave an update on monetary rule. This is a quote from your July Monetary Policy Report. It gives an update on monetary policy rules and their role in our policy discussions. I understand you have a series of rules that you reference as you are moving forward, including the Taylor Rule adjusted, the Taylor Rule as it is. What is the balanced approach rule? I mean, I'm not familiar with that. Balanced approach rule would have called for the most negative interest rates during the downturn, and could you unpack that a little bit?
So each of the rules most of them have an estimate of the neutral rate, inflation. They've got how far you are away from your inflation target and how far you are away from your unemployment target or your slack target. What the balanced rule does is it doubles the coefficient on the slack target. So in this case, unemployment. So the weighting is doubled on.
Okay.
That's all it is.
And then real quickly, Chairman Barr had talked about the yield curve flattening, and I'm wondering if there could be circumstances when what might be good for the federal government, lower interest rates long term as we deal with our national debt load payments, frankly, might that not necessarily be beneficial for the overall economy?
So we're not concerned with. We're concerned with carrying out the mandate you've given us, which is maximum employment, stable prices, financial stability. We're not concerned with fiscal.
Do you have discretion as to whether to sell short-term versus long-term?
Sure.
Okay, and if you sell long,
we don't sell any assets. We let them mature.
Okay, well, so okay, Well, I will have to follow up with some written on that because I am curious if you did sell those long terms, could the long-term rate go up? So, thank you, Mr. Chairman.
Time of the gentleman has expired. The chair now recognizes the gentleman from Connecticut, Mr. Himes.
Thank you, Mr. Chairman. And Chairman Powell, welcome. It's a pleasure for me to have this opportunity to chat with you, something I hope we can do on an ongoing basis in future. I want to use my 5 minutes to ask you about two specific risks and for your elaboration thereon. The first one is related to financial stability and stability in the overall financial system. I watched carefully the conversation you had with Senators Warren and Brown about capital. I'm actually interested in hearing you for a couple of minutes because I do have two questions. Elaborate on risks that we might not see coming that aren't conventional capital risks. So my concern, of course, is that we tend to get hit by the bullets that we don't see. And while we're focused on Volcker Rule or capital, what happens, what comes upon us out of nowhere, these things tend to come with a speed and severity that we don't predict. So what keeps you up at night that is not sort of conventional capital ratio type issues? Is it student loans? Is it proprietary trading? Is it ETFs? Elaborate for me, if you would, on things that concern you with respect to stability in the banking system in particular.
So the clear answer to me from that would be cyber risk. We've spent 10 years building up capital, helping the banks be much more conscious of their risks, building up liquidity, stress testing, all those things. And we have a really good playbook there. I think we carefully monitor all of the things that you mentioned, although some of them are worth talking about as well right now. But the thing that is really hard is the idea of a successful cyber attack. And we work hard on having a plan for that. The administration plays a leading role in that. That would be the big one. I think if you turn to traditional financial stability, we think that risks are sort of at the normal/moderate level. You see some high asset prices. You don't see high leverage among households or among banks. You do see a little bit of high leverage in non-financial corporates, and that's something we're watching very carefully. But again, nothing really is flashing red in our observation of it in the financial markets.
Let me ask you to elaborate. You said there are some worth talking about, and then you highlighted asset prices. Which category of assets in particular were you?
Just generally, you've had 10 years, almost 10 years of low interest rates, and we're in the process of normalizing policy. Bond prices are high, equity prices are, broadly speaking, commercial real estate prices are in the upper range. I think generally elevated. I wouldn't use the bubble word here, but I would say that many financial asset prices are elevated above their normal ranges, and we'll have to see.
With respect to cybersecurity, which is where you started, what would you recommend to this body that we do as you do your reviews and whatnot within the banking industry? What should Congress do to assist in the process of addressing cybersecurity risk?
Well, I would say as much as possible, and then double it. So we do a great deal, and it's about making sure the banks have basic plans in mind. A lot of it is just basic cyber hygiene and making sure that your systems you're implementing the latest things that come out and that sort of thing. And I think planning for failure too is very important. That's what we do. We do everything we can to prevent a failure, but then you've got to ask yourself, okay, what would we do if there were a successful cyber attack? You got to have a plan for that too. So those are the things we're working on.
Okay. Let me ask you another category of risk that is maybe a little bit more sensitive, but like so many people, I scrutinize the words in this report. My words, not yours. Very bullish on the economy, careful on inflation. You note that inflation has moved up. Our challenge will be to keep it there. I'm reflecting on where we've been in the last 10 years in that regard. We saw a pretty substantial fiscal stimulus in 2009. My friends on the other side of the aisle completely rejected Keynesian economics at the time and said that wasn't going to work. They then had an epiphany and embraced Keynesian economics around a $2 trillion deficit-financed fiscal tax cut at a time in which the economy was growing robustly. It's been a long time since I studied economics, but stimulus in the face of a robust economy concerns me from the angle of inflation. You say that the 2% objective is symmetric in the sense of your concern. how would you divide the probability that we see upward trending inflation versus downward trending inflation going forward from this point?
I would say it's roughly balanced. I think maybe slightly more worried about lower inflation still, but I think for a long time, inflation was below target and we were pushing up. We've now just about reached a symmetric 2% objective, so it's very close. And I think from this point forward, the risks are roughly balanced.
Thank you. Thank you, Mr. Chairman.
Time of the gentleman has expired. The chair now recognizes the gentleman from North Carolina, Mr. McHenry, Vice Chair of the committee.
Well, Chair Powell, thank you for being here. Thank you for being here. I want to shift to cryptocurrency, which is a bit of your monetary policy hat, but also a bit of your regulatory hat. And I want to get your thinking along the lines of cryptocurrency. So the Bank of International Settlements just released a report saying that cryptocurrencies were, quote, a poor substitute for the solid institutional backing of money. You've stated publicly that the cryptocurrencies are currently not big enough yet to matter, or something along those lines. I would submit the report by the Bank of International Settlements misses the mark of the potential of blockchain, the potential of crypto more broadly. But there's a great deal of interest in your views and central banks' views more broadly on cryptocurrency. So can you just outline to me your thinking on cryptocurrency?
Sure. So first, I would say, I think the question I was asked that you're referring to was, do cryptocurrencies currently present a serious financial stability threat? And my answer was, they're not big enough to do that yet.
Sure.
That's really what I was saying, not that they're not a longer-term thing. So they are very challenging because, cryptocurrencies are great if you're trying to hide money or if you're trying to launder money or if you're, so that we have to be very conscious of that. I think there are also significant investor risks. Investors, relatively unsophisticated investors, see the asset going up in price and they think, this is great, I'll buy this. In fact, there is no promise behind that. It's not really a currency. It doesn't really have any intrinsic value. So I think there are investor or consumer protection issues as well. Another thing I'll say is that we're not looking at this at the Fed as something that we should be doing, that the Fed would do a digital currency. That's not something we're looking at. So mainly I have concerns. I mean, if you think about what currencies do, they're supposed to be a means of payment and a store of value, basically. And cryptocurrencies they're not really used very much in payment. Typically people sell their cryptocurrencies and then pay in dollars. And in terms of a store of value, look at the volatility in it. It's just not there.
Well, has there been discussion with other G7 central banks along the lines of cryptocurrency?
It comes up a lot, yeah. I mean, I'm only just starting to go to G7 meetings, but it comes up quite a bit in international forums of various kinds. There's a broad concern that the public needs to be well informed about this, I think, and that again, the money laundering and terrorist financing and all of that is a big risk.
It's a big risk, but is there any conclusion that you're hearing, or is it just a broad concern?
Well, I think the BIS report and others have called out these risks and called on the appropriate regulatory bodies to address them. We don't have jurisdiction over cryptocurrency. We have jurisdiction over banks, and so we know in their activities with cryptocurrency companies and cryptocurrency, we can address that. Others can address the SEC can address the investor protection aspects of it.
But you don't see this as impairing your ability to act on monetary policy,
not
just given the current shape and scope of the size of the market?
Really not at all today.
Okay. So, we currently have some level of framework around regulation of cryptocurrency. You've got a money service license at the state level. In our 50 states, they all have some requirement. So there's a great look into that conversion, the movement of cash into cryptocurrency or out of cryptocurrency back into cash. We have some element of regulation at the CFTC and the SEC So there is some broad framework of it, but not a concerted effort by the federal government to understand what's happening in cryptocurrency. Do you have any staff resources devoted to figuring out cryptocurrency or following cryptocurrency?
Yes, so we've looked at it carefully. I spoke about it. Other governors have spoken about it. Reserve Bank presidents. There's plenty of work going on. But again, we don't have this regulatory authority to deal with it. So I think that's the key thing is to be looking at the places where there is that regulatory authority.
Okay. So, thank you, Chairman.
Gentleman yields back. Chair now recognizes the gentleman from California, Mr. Vargas.
First of all, I'd like to thank you for one thing that's obvious, and that is that you haven't gotten yourself in trouble. And thank you, Mr. Chairman. You haven't gotten yourself in trouble. You've been a great public servant, and I really appreciate that. Unfortunately, you shouldn't have to say that these days, but you really do, what we've seen recently. I do want to ask a little more about cryptocurrency, however. You talked about terrorism, and you also talked about hiding money. I had a bill here with a colleague of mine on the other side exactly on that point, and I'd like you to go a little deeper on that. You said it's not an issue yet because it's not large enough, but it does seem to be growing. And you said you also don't have jurisdiction over the banks. Should you have jurisdiction here, cryptocurrency?
That's a deep question. We're not seeking it.
But should you?
I'm not going to say yes today. We're not looking to. It's right in the middle of the SEC's turf, the investor protection aspects of it. I think Treasury and FinCEN and other people have. I think it should be well regulated. I don't really see us as probably the right group to do that.
But it seems to me right now that no one seems to have quite a hold on it either. It seems to be this amorphous glob that's moving around. You talk to the SEC, and they at the same time kind of kick the ball around also. I mean, shouldn't there be a more concerted effort to try to figure out who's in charge here of cryptocurrency? Because I think that there is lots of opportunities here for not only terrorism, but also for drug trafficking, sexual exploitation, human trafficking. You said terrorism, but all sorts of bad actors, I think, can use this. And I don't think that we have a good hold on it yet.
I think it's a good idea to focus on getting the regulation at the federal level of this right. Again, we're not seeking that at the Fed, but and I know Treasury has done some thinking on this. This would be an area where they'd have the lead to sort of identify the right regulatory structure. They may have already published something on this. I'm not sure.
In fact, part of the bill asks them to speed that up and to report back to us. I do want to ask you also about the issue of wage increases. You said that there's been some movement upwards, 2%, 3%. I think you said 3%, and so it's beating inflation. But the question was then specifically on people of color, African Americans and Latinos. You said you had some breakout numbers for those?
Not handy, I don't. I can get those for you.
Okay, I'd be interested in that because I see the same situation in California where you have people that have been underemployed, working very, very hard, 2 and 3 jobs, and they continue to say that they haven't seen that wage increase yet. We have seen for sure, and I think you're correct about the unemployment go down, but we haven't seen yet, certainly not in my district, in any measurable way, the increases in wages.
So wages in general have been somewhat slow in moving up. And as the labor market has tightened, and we understand that really matters to people's lives a lot. Yeah. And we do see them moving up in the aggregate, but I'll also be happy to supply.
You said there was an issue of productivity because maybe this time the reason the rates haven't increased as much is because of productivity. Could you talk about that for a second?
Sure. So over a long period of time, wages really can't forever go up faster than productivity. Productivity is slow, but there's a reason for that, and that is after the financial crisis, there are many reasons for it. After the financial crisis, though, companies didn't invest much because there was no need to, there wasn't demand, the economy was weak, and so weak investment it casts a shadow over productivity growth for a number of years. So investment has now popped up. Investment was strong in 2017, that continues in 2018. That's really important, and we're glad to see it. But it may take some time to show up in higher productivity. It's not because people aren't working harder. It's because you need those information technology and other tools to be more productive.
And again, with the last moments that I have here, I just want to thank you again, the way you've comported yourself, the way you've been open to talking to people, the confidence that we have in you. I think the American people really need at the moment someone like yourself that we can look up to and say, you're not involved in any kind of scandal. You're not involved in any other thing out there that would lose confidence. It's just the opposite, and I want to appreciate that, and thank you for that.
Thank you, sir. I'll try to live up to that.
I hope you do.
Gentleman yields back. Chair now recognizes the gentleman from Wisconsin, Mr. Duffy, chairman of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman, and thank you, Mr. Powell. I'm up here on the back row. You probably can't find me. Some of my colleagues on the other side of the aisle have discussed harmful economic policies, some in their opening statement specifically. So if you look at the harmful economic policies that have taken hold over the last year and a half. So President Trump has worked hard to streamline and reduce regulation. We had a historic tax cut. We've tried to rebuild our military. We've pushed for American energy independence. If you take together all of, I would quote, those harmful economic policies, what has that actually done for the African American unemployment rate in America?
As I mentioned, I think...
Has it gone up?
It's gone down significantly.
Say that one more time. What's happened to African American unemployment?
It's come down quite a bit.
It's come down quite a bit. How about the Hispanic unemployment rate? Has that gone up under these harmful economic policies?
It has come down quite a bit.
It's come down quite a bit. So is it fair to say these policies actually aren't harmful? They're actually growing the economy. They're putting people back to work. Is that a fair assessment, Mr. Powell?
It's fair to say that the unemployment rates are very low, and that a lot of things go into that.
So you wouldn't say today that it has anything to do with regulation or tax?
I'm reluctant to get into the credit assignment game. It's really not up to us. I can report on the economy, but I do think that...
But I know, but you report on the economy and you look at all the different factors that come into play in the economy. And so have these factors had anything to do with the growth that you have seen in this economy?
I attribute declining unemployment to, positive surveys among businesses. Really, they feel good about the business climate.
Why do they feel better about their businesses, Chairman? Because they get to keep a little more of their money? Is that possible?
Certainly.
Maybe? How about if instead of having to navigate government rules and regulations, they actually get to focus on running their business? Could that attribute to the positive view they have on the economy and their businesses?
I think you've seen very positive business confidence surveys.
Okay. So I'll take it that you're not going to answer my question. I understand the position in which you sit. I want to talk to you about trade. I'm a free trader like you are. I think free trade is great for our economy. But I also think that if you don't have fair trade, if you have deals with places like China where you have American companies that invest millions or billions of dollars in their technology and you do business with China and they steal it from you, or they subsidize their companies that come and do business in America where we have, for the most part, free trade ourselves, where we actually can't, they have barriers to American-produced goods. How long does that relationship last where our economy is open, theirs is closed? Does that set us up for a long-term successful economy as it relates to China?
So I strongly agree with you that trade needs to be fair as well as free.
Is it fair now?
Well, I think if you look at the rules-based post-war system, it's consistently resulted in lower and lower trade barriers.
No. Our relationship with China, is it a fair trade? Do you have a fair trade relationship with China?
I think it's very clear that some countries, and China in particular, have less open trading systems than we would like, and it's
not fair.
Appropriate for us to address that.
And so do you think it's easier to deal with China 15 years from now when their economy is that much larger and stronger, or maybe their military is larger and stronger than it is today?
That's really a judgment for the people who have responsibility for trade policy.
I would agree with that. I'm going to quickly turn to the President's America First policy. Do you agree with that?
Maybe you could be more specific?
Well, do you think we should put American interests first? Do we think we should look out for the global interests or American interests?
I mean, we work under a statute that has us focused on maximum employment and stable prices here in America.
Maximum employment for Americans, not for the globe, right?
In America.
So we're looking out for Americans.
Of course, we live in a global economy where the global economy affects that.
No, that's true, but we can look at the global economy, but always how it affects our own
Entirely
people.
domestic. Our goals are entirely
Do
domestic.
you believe the U.S. insurance companies are well capitalized and solvent today?
Yes.
Do you believe that our system of regulating American insurers has worked well over the last 150 years?
I can speak to the last decade or so, and I'd say yes.
Pretty good, huh? So would you agree that we should not enter any international agreement or standard setting that would undermine our U.S. Insurance regulatory system, state-based model?
Yes, yeah, I would.
Great. My time is up. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Sherman.
I commend the gentleman from Wisconsin and the chair of the Fed for their comments about insurance, and I'll probably disagree with many other things. Thank you once again for returning, where you will be independent and accountable, tall and short. The Fed plays an interesting role. First is to cryptocurrencies. You and we should have the courage to ban them. As an investment, they're an investment with no investor protection. And they take the animal spirits, the willingness to invest, divert them from the real economy, and instead engage in what is basically gambling. Many jurisdictions support gambling only if there is local taxation, but cryptocurrencies don't pay gambling taxes. As a medium of exchange, cryptocurrencies offer no advantages over regular currencies unless you're a terrorist, a narcotics dealer, or a tax evader. There is no positive role for us for cryptocurrencies. A lot of discussion in here about who deserves credit for the good economy. Let me point out, since Dodd-Frank, 17 million jobs have been created, 15 million of them under Obama, 2 million under Trump. That's 15 million, 2 million. That's the right ratio. Now, the Trump administration claims credit for the last 3 months of the Obama presidency, but Obama was actually president until January 2017, but his policies remained in force all through 2017. Dodd-Frank, Janet Yellen's balance sheet, and Obama tax policies were in force until the beginning of this year. And in fact, the Fed policies and the securities regulation remain pretty much unchanged since the Obama administration. The chairman of this committee urges you to abandon all of the unconventional tools while taking credit for the good economy that is in part a result of your unconventional tools. I would say keep your balance sheet as big as it was when we achieved the economic growth that is so good that Democrats and Republicans are fighting over who gets credit. And certainly do not cut your balance sheet until Chairman Hensarling tells you how he's going to increase taxes to replace the $80 billion of profit you gave us last year because you had a big balance sheet. The chair talks about the inflation rate, the chair of this committee. You ought to have a goal of 2.5%, not 2%. The law that we passed in 1978 draws a 3% objective or maximum for inflation and for unemployment. So unemployment is still too high and inflation is too low, and if we have a looser economic policy, maybe we'll get somewhat higher inflation and the labor shortage necessary to increase wages. He puts forward the idea that somebody would save for their daughter's college education by putting money aside, but in a mattress where its value would decline by 30% by the time his young girl got to college. I'd say if you're smart enough to save for college education once your daughter is born, you're probably smart enough to invest the money in something than inflation. As to trade, my party suffers from Trump derangement syndrome, which is whatever Trump does, we have to be the opposite. The fact is, China launched this trade war against us in the year 2000, right after 2/3 of Democrats voted against giving China most favored nation status. We were right then. We shouldn't change now. If there are those who say that trade deficits don't have a harm, they lead to hollowed-out manufacturing, which leads to manufacturing towns where you have opioids, alcoholism, and votes for Donald Trump, 3 terrible scourges that hit the Midwest. As to your testimony, Mr. Chairman, you say that wages are growing a little faster than they did a few years ago. That's nominal wages. Real wages, if anything, have stagnated over the last year, depending upon your measure of inflation. One more reason for a looser monetary policy, faster economic growth. And, believe it or not, I have a question. That is, LIBOR was tainted by a scandal. You've got the Alternative Reference Rates Committee. Most of the LIBOR referenced debt is derivatives, but what really matters to people is mortgages. And what are you going to do to make sure that the new benchmark doesn't increase mortgage bargaining costs or disrupt the mortgage market?
So
that's the one question.
That's great. That's a great question. So you're right. Many mortgages reference LIBOR. LIBOR is a rate that's under a lot of pressure. It may not be there in 3 or 4 years, so there's a big move to find a good backup. We've identified a backup, and it's not designed to represent an increase at all in people's mortgage costs. Rather, it's designed to represent just a more sustainable rate that'll always be there and less volatile and more predictable, more reliable.
And it'll be as good for mortgages as it is for derivatives.
Yes.
Good.
The gentleman's time has expired. The chair now recognizes the gentlelady from Missouri, the chair of the Oversight and Investigation Subcommittee, Ms. Wagner.
Thank you. I thank the chair and welcome Chairman Powell. In comments that you made shortly after being sworn in as chairman of the Federal Reserve, you noted that you were committed to, and I quote, explaining what we're doing and why we are doing it, and will continue to pursue ways to improve transparency both in monetary policy and in regulation. Sir, how much value do you place on being as open and transparent as possible so that not only Congress but the American people understand the decisions the Fed is making, why they're making those decisions? I'm just interested in what that kind of transparency and openness looks like.
So I think it's our obligation to explain ourselves. What we do is very important, sometimes not well understood, and it's really on us to explain what we're doing with financial regulation and monetary policy. We have this precious grant of independence. We have to earn it by being accountable, and the way we do that is through lots and lots of transparency. I mean, I see myself as following in the footsteps of 3 prior chairmen who worked on this: Greenspan, Bernanke, and Yellen.
When you say transparency, what are we talking about in a specific
in my case,
fashion?
you know, so we doubled the number of press conferences. I'll have a press conference after every FOMC meeting. That's in monetary policy. That's a way for me to get out and talk about what the committee did at each meeting and communicate to the public in a comprehensible way. I've also focused very much on communicating in terms that people can understand generally, not just economists. There's a very small professional audience that understands what we do very, very well, and economists in Wall Street and that kind of thing. And I think the rest of the country needs to be let in on this too, and I'm trying very hard to do that.
I absolutely agree, especially in this era where we have a savings crisis, and people need to understand the movements that you make as Fed chair, how it relates to monetary policy and how it affects them and how they invest for their future. So I absolutely applaud your efforts in terms of press conferences, but also trying to shape the vernacular so that everyday low and middle income investors and savers in this country can understand what your policy actually means to them personally. In 2012, the Fed dealt with a leak of confidential information relating to the deliberation of the Federal Open Markets Committee, FOMC. As you know, access to that information is valuable to markets and investors because the Fed does not make clear what it is likely to do in the future. The committee believes that a monetary policy rule would provide the public transparency into future monetary policy decisions and eliminate the value of leaks. Again, you've talked a lot about being transparent, and we've discussed it here previously, but you're the new boss, and what's going to change on the issue of securing some of that confidential information and transparency to prevent this going forward? And then also, when will the board improve its internal governance so episodes like these don't repeat themselves, sir?
We take the confidentiality of our deliberations very, very seriously, as you, I'm sure, know and would imagine. And, you know, we remind every person who has access to FOMC information, including all the participants, but also all the staff, every year have to review those rules, have to signify that they understand, have read them, and are bound by them. So we do all of the things we can humanly think of to make sure that people understand their obligations to confidentiality, and I think
if I could interrupt, sir, as chairman of the Oversight and Investigation Committee, we have looked into this specific leak. We've had difficulty receiving, I think, specific information about your internal governance and exactly, you know, how it is that we make sure these episodes don't repeat themselves. So, you know, I'd like your brief comments on that, and also want to work with you to make sure that we're receiving the information in our role of oversight and investigation into these kinds of matters.
I'll be happy to take that offline and talk to you about it. I don't know what you're referring to about information you can't get. Obviously, there's a lot of confidential information that we don't release, that we try to protect. But in terms of our procedures and the kinds of things that we do, I would think that that's the kind of thing we...
Specific to improvements of internal governance, I believe so. Okay. I thank you. I look forward to following up with you. And Mr. Chair, I yield back the remainder of my time.
Gentlelady's time has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you, Mr. Chairman. Chairman Powell, excuse me. Welcome back again, and I want to thank you for spending some private time with me. We had a wonderful discussion and covered a lot of territory when you were here last. But I watched your testimony over in the Senate on yesterday, and I want to clarify something with you. You talked about the regional banks, those banks that are at the between 100 billion and 200 billion in range. And you talked about Senate Bill 2155, which I supported very strongly, and we got good support on in terms of the banking regulations. But in Senate Bill 2155, we gave you, the Fed, substantial authority through rulemaking to tailor regulations for these mid-sized banks, for these important regional banks. And I watched the testimony, and you reassured the senators that the Fed wasn't going to just flip the switch off on a bunch of the enhanced prudential standards, but instead would diligently work through a thoughtful and careful rulemaking. And I was very pleased to hear that. But I want to ask get some clarifying information from you. Because Georgia, as you may know, is the home of a couple of these very important regional banks, Regions Banks and SunTrust Banks. And the question is, do you envision the end product of this thoughtful and diligent rulemaking process to be a set of enhanced prudential regulations to these SIFI banks that is drastically different than those of the G-SIBs or the global banks?
I anticipate that we will begin by identifying and then putting out for comment a framework that we'll use to assess financial stability and safety and soundness risks of those institutions from 250 down to $100 billion. And we'll take comment on that, and then we'll go ahead and move forward with a framework. And I anticipate that many of the factors that are used to identify the SIFIs will be used in this context as well. We're still working on exactly how to think about it. We have great flexibility under the law, which we appreciate, and we'll be coming forward with something on this pretty quickly, I think.
Do you see any problem areas that these mid-sized banks or regional banks might have to be concerned about? Or do you see a sort of a clear field here?
Well, I guess I would just say we're going to go ahead and do what the law asks us to do. I don't see why anyone should be concerned about that.
Good.
So.
Wonderful. That's good to hear. Those banks, all our banks are very important, but we have so many different sizes, and we got to make sure there's a level playing field for all of them. Now, let me ask you this question. You know, one of your fellow cabinet members was here, the Treasury Secretary, and we got into discussion on the trade situation. So I want to ask you a question that I asked him, and I'm hoping I will get a different answer. And that is this: are we or are we not in a trade war?
Let me say, of course, as an independent regulatory head, I'm not a member of the cabinet, but and also I'm not at an independent agency that has any authority over trade.
But the reason this is so important, you may not be a member of the cabinet, but let's face it, Chairman Powell, when you sneeze, Wall Street gets pneumonia.
Better than the other way around. So on this, we do have responsibility for the economy, and to the extent we see.
But my time is coming out. I need an answer. Are we or are we not in a trade war?
It's just not for me to say. Sorry.
Well, Mr. Powell, you are our anchor. You are, as the head of the Federal Reserve, the fulcrum of our economic system. And on top of that, I've talked with you, and you are a very learned, intelligent person. And you have a very important opinion that the people of this nation would want to hear from you. Are we or are we not in a trade war?
The gentleman's time has expired. The chair now will recognize the gentleman from Oklahoma, Mr. Lucas.
Thank you, Mr. Chairman. And Chairman Powell, you are my fourth chairman of the Federal Reserve that I've had the opportunity to interact with as a member of this committee. And I've over time come to appreciate that the best use of my time perhaps is to focus on more specific issues, since my friends are very broad sometimes in their inquiries of you. So I'd like to ask you about the recent proposal the Fed released with other agencies regarding the Volcker Rule. And while a great deal of attention has been paid to the proprietary trading restrictions, I'd like to focus on the manner in which banks have been restricted from making long-term investments in small businesses, startups, emerging growth sectors as a result of the covered funds provisions. I can understand that the agencies want to ensure that banks cannot evade the trading restrictions of the Volcker Rule through certain private funds, but I am concerned that the agency's interpretation of the restrictions on investing in funds that facilitate capital formation has resulted in prohibitions on an activity that we want banks to engage in, such as making long-term investments in American companies to help them grow. These restrictions cut off as a source of capital where they are both needed and important to economic growth. And I will note that the venture capital groups also share my reservations, and Comptroller Auditing testified last month that bank lending provided key funding to small businesses by investing in these funds. Do you have any plans to modify the scope of the restrictions on banks' long-term investments in covered funds so that the banks are able to serve as an important source of capital to these funds?
As you know, we put out that proposal, and we're very eager to hear comments on that. I think we're bound by what the statute says, but within that, we don't see this as an activity that typically threatens the safety and soundness. So, we'd be willing to do whatever we can within the statutory language and intent to accommodate that activity.
I'm going to define that as a very positive answer. And in the respect for my colleagues, yield back the balance of my time, Mr. Chairman, while I'm ahead.
Gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Green.
Thank you, Mr. Chairman. I thank the ranking member as well and welcome the chair back to the committee. I want to thank you for this effort that you're making to talk to members of Congress. I think it's important for you to hear from us, and I appreciate greatly your outreach. Also appreciative that you've made some reference to African American unemployment in your statement for the record. I think that's important as well. And like many, I salute the notion that African American unemployment is low, comparatively speaking, but I still am concerned about the historic position that it continually occupies, and that of being twice that of white unemployment, generally speaking, sometimes a little bit less, sometimes a little bit more. And to this end, you and I will continue our interaction about this, see if there are some things that we may be able to do collectively to have an impact. I want to move quickly to something related to the United State of Texas and tariffs. Texas is the 10th largest economy in the world. And based on GDP, it is, of course, our nation's top exporter. In Texas, we export $42 billion in goods to China, second only to Mexico. Half of the U.S. cotton exported to China comes from Texas. While you have not captioned it, you've not styled it as a trade war, I assume that you would say there is a dispute. And this trade dispute is having an impact on people in Texas. But I'd like for you to give your thoughts on how it will impact middle-class Americans, if you would.
Sure. So I think as it relates to China, it's appropriate to address the problems with China's trading regime as well. That's a very appropriate thing for the U.S. to do, and we've been doing it for a long time, and I think it's something to carry on. I think, and again, we're not in charge of trade, but I think it's hard to know exactly where this process goes. If it goes to a place where we lower trade barriers elsewhere and U.S. trade barriers go down, then it might be worth paying a little bit of a short-term price to get to that better place. Lower trade barriers, lower tariffs help our economy over time. They make for a better, more productive economy, higher incomes. They don't help every single group, and we need to do a better job of addressing the groups that are not helped by trade. I think if you go more broadly in a more protectionist direction over time for a sustained period, that is bad for our economy. That will mean lower incomes and lower productivity, and I just hope it doesn't go in that direction. But I think it's hard to say where it goes from here.
Well, we do have Canada and European allies engaged in the dispute currently. So it's a little bit bigger than China. To what extent it will grow is, I suppose, to be seen. But given that it seems to be consuming other nations as well, how, again, will this impact middle-class people, assuming that we continue along the path that we're going?
I think an open trading system worldwide with low barriers is good generally. It creates rising incomes for middle-class people and all different kinds of people generally. Not every group is helped, though, and we know that for factory workers who lost their job over the years. And I think we need to do a better job of addressing those issues.
So is it fair to say that persons who have been traditionally among those who are unemployed at a higher rate, that they'll be impacted adversely to a greater extent?
I think that's probably right. I think the groups who are it's groups who are more at the margins of the labor force, at the lower end of the labor force in terms of compensation, things like that, who get hit the hardest in a downturn. So unemployment goes up the most for those people. And I think they tend to be the ones who are hardest hit by downturns generally.
And for the record, I would simply add that it appears that African Americans would probably be a part of that group. And I thank you for nodding. I yield back the balance of my time.
The gentleman's time has expired. The chair now recognizes the gentleman from Illinois, Mr. Holtgren. I'm sorry. Strike that. Mr. Stivers. My apologies, Mr. Stivers from
That's
Ohio.
all good. Thank you, Mr. Chairman. I looked around and made sure I was here for a second. Thank you, Mr. Chairman. Thank you for being here, Mr. Chair. We appreciate your ability to be very accessible to all of us. I know you're in my office. You've been in a lot of our offices. Appreciate that. This hearing today is about the state of the economy and monetary policy. And if you could just give me some true or falses here, we'll give a quick summary to people. Is it true or false economic growth is 3.1% the best in over 20 years?
I don't know where you got 3.1%, but it was 2% in the first quarter. It's going to be way higher than that.
This quarter, that's projected to be 3.1%.
It's going to be
or around that.
Higher than that.
Okay, higher than that.
Quarter will be
all right.
projected to be higher than that.
So, good economic growth. True?
Yes. True.
Low unemployment, below 4%.
It's at 4% today, projected to go lower.
Okay, around 4%. Wage growth is increasing.
Has increased.
Has increased. And we have stable prices.
We're close to our stable prices.
Close to our stable prices. So as you think about the full employment mandate that you have, the Fed has historically used the unemployment rate. And over the last 10 years, what we've seen, although it's picked up a little bit lately, is a decline in the labor participation rate. Don't you think that would be a better proxy for you to use when you compare the United States to the UK or Japan? Their labor participation rate is 5 to 7 points higher than ours among, working age people.
So we say in our longer run statement of principles and monetary policy strategy that we actually look at a broad range of indicators to define maximum employment. And it's many, many measures of unemployment. It also includes labor force participation. I would strongly agree with you that that's a very important area of focus for us, and I believe for you as well. It's an area where the United States has fallen behind other advanced economies, and it's an area where we need to do better.
I think we need to transition there. There are a lot of people left behind, and whether they're looking for work or not, we need to figure out how to get them moving toward the American dream, and I appreciate you being willing to look at that. Quickly on the Volcker Rule, I just want to speak for middle America. We have a lot of banks in my district, medium-sized banks, little banks. They are precluded from investing in our economy. They can loan to our economy, but they can't invest in our economy. And, the preponderance of the wealth that's invested in private equity and other things is on the coasts. If we were to, and I know it would require a statutory change, if we were to allow some of that investment to happen, but separately capitalize those funds at the banks so they can't just come to the Fed funds window, that's the concern. I get it and why the Volcker Rule is there. It would really help middle America. I'm not asking you to comment on it, but I'd love to work with you on that issue.
Great. We'll do that.
Quickly, a follow-up from Mr. Himes on cyber policy. With regard to the thing that keeps you up at night the most, I think everybody you regulate inside the financial system has incentives that are aligned with behavior that work. Because the customer is limited to a $50 loss, the financial institutions have skin in the game. The problem is many other people in the cyber system, retailers and others, offload their financial risk while they have reputational risk to others. And it's become a jurisdictional fight between our committee and Energy and Commerce. I believe we need to change that, and I think the way to do it is to use cyber insurance the way we used workers' compensation insurance in the 1900s to improve worker safety. If we gave safe harbors for certain coverages and made sure the payouts aligned the incentives, I think you'd be able to price a system, but you'd have a dynamic system instead of naming standards and having them be an out of date the next day. So we look forward to working with you on that. I don't expect you to comment on that either, since I'm just throwing at you right now, but I think it's a different way that maybe can break through our jurisdictional problem inside Congress. But I agree with you, it's one of the biggest threats that we have right now. And quickly, one last thing, and this is a question that I do want you to address, because there have been some comments on the committee about stock buybacks and how they don't do anything, but I think it's important that we note that when a company decides to buy back stock, that money doesn't just disappear into the wallets of wealthy people. It goes to work inside the corporation. It's their way of saying this is a better way to put our money at work. But when you look at stock ownership, many people in the middle class have 401ks, and that money gets a better return for them as well as every other stockholder. So I guess the point is, and you've answered it a couple times, but just to be more clear, do you believe that stock buybacks can help the economy and the middle class, including 401k stockholders?
Yeah, I see stock buybacks as a way for companies to allocate funds that they don't need in their own business through the capital markets to those who do need them.
The gentleman's time has expired.
Thank you. I yield back.
Thank you. And just as an announcement, the chairman has requested a brief break at noon, so we will recognize the gentleman from Minnesota and then take a recess for a few minutes. And now we recognize the gentleman from Minnesota, Mr. Ellison.
Thank you. Good morning, Mr. Chairman. How you doing?
Great, thanks. How are you?
So there's been a little bit of discussion about whether or not real wages have gone up or gone down, but I'm just looking at what was reported by the Bureau of Labor Statistics yesterday. They said that median weekly earnings of the nation's 116 million full-time wage salaried workers rose 2% on the year, but inflation was up 2.7% over the same time period. That says to me that the median full-time wages have actually been falling in real terms for the past 3 quarters. Would you agree with my analysis?
Yes, as
Okay.
far as it goes.
So thank you. And I appreciate that because that allows me to ask what I really want to know, which is like why in such low unemployment do we have wages either stagnant or even declining a little bit over the last 3 quarters? And I'll just give you a minute or two to try to give me some understanding, all of us. And it's not a set-up question. It's a real question because you would expect with this level of low unemployment, we'd see wages go up, but they're not. So what is some of your observations as to why that's happening?
So if you look at, we look at a range of wages, of course. There are 4 or 5 main ones, but there are many, many others, and they have differences. None of them is exactly right. And if you look at them, they've overall moved up from around 2% to pretty close to 3% now. That's good. We like to see
Not nominally.
This is nominal. Yeah, this is nominal. It's reported in nominal, not real. So that's a good thing, though. We like to see that moving up. I've said before, and I still think I would, you would have expected when unemployment moves from 10% to 4%, you might have expected a little bit more in the way of increases. On the other hand, inflation has been low. Employers are looking at this through the lens of how much are prices going up, and the answer has been inflation's been low, and also how much more output am I getting? How much, in other words, people should earn inflation plus productivity. Both of those have been low through no fault of any worker.
Now, Mr. Chairman, I hate this process because it makes me interrupt you, and I appreciate what you're sharing, so I didn't want to do that. But I think it has something to do with anti-competitive practices that we see across various sectors. For example, many of us have a piece of legislation to ban something called no poaching agreements. Do you know what a no poaching agreement is?
I do, yes.
Could you describe in about 30 seconds for the folks listening what a no poaching agreement is?
So, for example, you work at a fast food outlet. As a condition of getting that job, you have to promise not to take a job at another fast food outlet. It's probably unenforceable, but a worker working in a fast food outlet doesn't have the means to go to court and might not know to go to court. So it's a way of restraining competition, and there's really nothing good to be said about it.
Right. And to me, I think that Congress needs to be aggressive about this, because if we are truly believing in free market economics, the free market is being restrained by these anti-competitive practices. This ought to be a bipartisan thing where we are together saying that if you cannot, Mr. Employer, Ms. Employer, have an agreement between yourselves that you will not hire each other's employees if they go to you looking for a better wage or have a non-compete clause.
I think just shining a light on it helps, by the way. You may have seen some of the big fast food companies announce they won't do that anymore.
Well, because some Democratic attorneys general went after them and they said, okay, we won't do it because they know they're going to be held accountable. But deeper than that, I think, is the fact that we have highly concentrated markets these days. Can you talk about market concentration in this particular economy. It seems like every industry you look at has highly concentrated markets. Look, for example, Amazon, how they're dominating, online retail. Or if you look at search engines, look what Amazon's doing. Or it could even be beer or pizza or chicken or whatever it is. It seems like the other side of a monopoly is a monopsony with a limited number of buyers of labor, which makes it easier for them to simply hold wages down. I wonder what you think about that.
It's true that we do see measures of concentration going up. I think that the sort of tech companies that come out and invent a new business, they're a special case. We're not, and it's hard to know how to think about that in terms of the traditional antitrust and other ways. It's not something I feel like there are really clear answers on yet.
Would you consider having the research department at the Fed talk about concentrated markets and the impact on wages and the fact that they're growing very slow in an unexpected way?
We'll look into that.
Thank you.
Gentleman's time has expired, and pursuant to the announcement just made, the committee stands in recess subject to the call of the chair. The chair anticipates that we will reconvene in 10 minutes.